A massive port strike is threatening America's fragile supply chains, while the Federal Reserve scrambles to prevent a surge in unemployment. At the same time, the race for the White House is tightening. Yet investors remain highly optimistic, pushing the U.S. stock market into unprecedented territory. The S&P 500 has already hit 43 record highs in 2024. On Monday, the index reached a new peak, marking a 20.8% gain for the year, its best start since 1997, when the economy was booming during the dotcom era under President Bill Clinton. This year's stock market surge has been fueled by optimism around a soft landing for the U.S. economy, with impressive performance attributed to the economy's resilience and growing enthusiasm for Federal Reserve rate cuts. However, concerns remain. Wall Street began October, a historically weak month, on a sour note, as U.S. stocks dropped on Tuesday after the White House warned of an imminent ballistic missile attack by Iran, driving oil prices higher. Tech stocks, including Nvidia, also suffered as a powerful typhoon approached Taiwan, threatening to disrupt the island's chip production. Despite these setbacks, investor sentiment has improved significantly from just 2 months ago. In early August, a poor jobs report stoked recession fears, leading to a market plunge. But those concerns quickly evaporated, and stocks soon reached new highs. Now, the focus is shifting to FOMO, fear of missing out. Investors are anxious about missing the rally, driving much of the trading activity. However, some are considering okay missing out, which may be a safer strategy. Given the high valuations of many stocks, it might not be wise to take excessive risks at this point. Valuations remain stretched, with the S&P 500 trading at over 21 times 2024 earnings estimates, well above its 5- and 10-year averages, after an 8% gain this year. Analysts expect S&P 500 companies to see just 3.6% profit growth in the first quarter, largely driven by tech companies like Nvidia, Supermicro, and those in artificial intelligence, along with parts of healthcare, such as weight loss drug makers Eli Lilly and Novo Nordisk. We're still seeing a dichotomy in earnings, says Joe Amato, Chief Investment Officer at Neuberger Berman, noting that profits in many cyclical sectors may decline in the first quarter. But earnings are expected to improve later in the year, with second quarter profits forecast to rise nearly 10%, and overall earnings for 2024 projected to be up 11% from 2023 levels. This potential momentum in earnings could be supported by the resilience of the U.S. economy. Still, uncertainty looms over whether consumers and businesses can continue to spend enough to support broad-based earnings growth. While inflation may be cooling, many Americans feel the pinch of soaring rent and gas prices, making it harder for companies to keep raising prices. Wall Street is counting on strong earnings growth, especially as hopes for further rate cuts fade. The positive news is that strong profits, even amid higher interest rates, could help offset inflation concerns and a less accommodative Federal Reserve. Despite repeated predictions of a recession, consumer spending has remained resilient, proving to be a critical pillar of the U.S. economy. The Federal Reserve, serious about protecting the job market, delivered a substantial rate cut last month to prevent further unemployment increases. People keep expecting a downturn in consumption, but it hasn't materialized. U.S. consumer spending remains strong. Don't miss out on the video above. Thanks for watching. Good luck and good profit. By Edward Cash Trader. Please read the disclaimer in the description below.